Okay, peeps, welcome back. So today we're going to be going over how to sell options in order to make passive income. Let's get it. So, how exactly do you go about selling options, and what is what are options? Basically, what pretty much what options are is the right to buy or sell in this case underlying securities at a given strike price at a certain price in the future. That's essentially what options are. So, how do you make money selling options? Well, there's two different ways that you can make it. You can sell a put, or what's known as a cash secured put. This means that in order to be able to do a cash secured put, you would have to have enough capital set aside to be able to write the put on 100 shares of stock, whatever that stock is that you're looking at. And the flip side of this would be selling calls, or what's known as covered calls. So in order to do a covered call, you have to have 100 shares of the stock already in your possession to be able to sell the call on those shares. So we're going to get into both sides of how this works. So we'll go over a example with a stock that we actually already currently own, which is CleanSpark. This is a Bitcoin miner, as you guys know. This is, of course, those of you that have been subscribed to us for some time, you already know how this works. We are invested in Bitcoin miners for the crypto bull run, but this does also serve additionally as a way to generate extra income. Now, you guys do see that we're down 37%. Unfortunately, bad timing on our part. We did get in at literally exactly the wrong time, and it pulled back almost immediately. So, yeah, lesson learned there, but is what it is. It happens sometimes. It's a rare occurrence for us to get put in a situation like this. I think it's happened like maybe 3 times over the last 12 months. It does happen. Not all of our positions actually look like this, but anyways, so let's go ahead and get into how this works. So we're not buying options. What we're doing here is selling options. So basically, the way that we usually trade options is we do weekly options. If the premium's not enough, then we'll go out to something like a monthly option. One of the reasons we've chosen the Bitcoin miners, other than the fact that the Bitcoin and crypto bull run is coming up, the true bull run, the altcoin season, all that kind of stuff coming up towards the end of the year, is because the implied volatility for these Bitcoin miner stocks is just off the charts. As you guys can see here, 123%. So massive volatility. Premiums are pretty good. So 3 days. If you were to do a cash secured put on this right now, let's say you wanted to be safe, you want to have a low risk of assignment, or if you do get assigned, you want to get a lower price. Maybe go with something between like a 0.2 to a 0.3 delta. So what is delta? Delta is basically, if you flip this, inverse this number right here, that basically tells you the percentage chance you have of not getting assigned the shares, or basically getting to collect the premium but not being forced to accept the shares, because again, these price of the underlying stock has to go below the strike price. So let's break this down on how this actually works for a cash secured put. Okay, so pretty much what you're doing here is you're saying, okay, I want to buy 100 shares exactly of this stock, but I want to buy it at a lower price. And you decide, of course, the time frame in which you want to buy it. So it could be any of these, anything from a week to a couple of years out. And you say, okay, the current price is $14.82, but I think maybe it could come lower. And you want to collect premium, but you don't want to pay the current market price because you think it's expensive. So you say, okay, maybe I'll do something like $13.50, $13, somewhere between a 0.2 to a 0.3 delta. And then what will happen is you'll have to have the money aside for this. So basically $13.50 or $13.50 times 100 contracts is $1,350. So that's the capital you would need to have set aside to basically ensure that if you are assigned the shares, you can buy them because you have the money to afford to pay for it. And as a result, you would collect $20 in premium and your contract would expire in 3 days. So whether these shares get assigned to you or not, either way, you get to collect the premium. That's what's so great about this. So if you decided that you want to buy at that price, but you think that $20 is not enough in options premium, again, $20 for only 3 days is pretty good. But you say, no, I want some more premium than that. That's not good enough for me, and I don't want to have to look at this thing in 3 days. Then you can go out 10 days, which is basically, I believe these expirations are every Friday. So yeah, that would be the next Friday. You pick the exact same strike price at 13.50, or well, in this case, you'd want a little bit lower delta. So maybe go to like a 26 delta, which is roughly about what this would be. So you get $40, basically $40 for roughly about 8 days. And then one of two things can happen. Either it's the price of the stock is going to close at expiration below the strike price. If that happens, you will be assigned the shares. Again, 13 times 100 is $1,300. So you need to have 1,300 set aside in order to do this. Or the other alternative is that this then closes above the strike price. If that's the case, the contract expires worthless. You do not have to collect the shares, and you still get to keep the $40 worth of premium. And then if you wanted to, you could just turn right around and do another cash secured put. So that's how cash secured puts work. So here's basically what's known as a sell call. It'll pop up here as, I believe it pops up as a covered call, if I'm not mistaken. Yep, covered call. So the flip side of the cash secured put is a covered call. And the way a covered call works is you intend to buy 100 shares of the stock. Or sorry, no, this is, my bad, that's cash secured put. So covered call, you already have 100 shares of the stock, okay? So you either basically bought 100 shares off the market, you DCA'd in, said, well, I'm going to buy like, 5 shares a day or something like that for 20 days. So then you eventually get to 100 shares. Or you did the cash secured put and you got assigned 100 shares, or you intentionally did like an at the money cash secured put so you would get assigned the shares. Then you have 100 shares and you can write a covered call. So the gist of this is you have to have 100 shares of this stock or whatever stock you want to buy, or I should say sell a call on, in order to actually sell a covered call. So pretty much just flip the cash secured put here. So what we're looking for is somewhere between a 70 to an 80% chance of profit. So what we're actually really looking for here is somewhere between a 0.2 to a 0.3 delta. So this is 0.3. If you wanted to be a little bit more on the safe side, you could go 0.25, or even safer than that, you could go 0.2. We generally like to aim somewhere between 0.2 to 0.3, nothing real specific. We could just pick this one and say, so you want to do 0.2. So basically what you would do is you would then write the covered call on the 100 shares that you already own. Of course, I'm not telling you to do this. This is how this process would go. You collect the $40 in premium, and the shares that you have would be locked up as collateral until basically the assignment, or I should say the contract, expires. So what's going to happen in this scenario at expiration? Well, there's two possibilities here. Number one, the share price goes up or down, but at any point in time, or I should say it lands at any price by expiration below the strike price. Any price below the strike price, the contract will expire worthless. You will get to keep the $40 in premium, and then you'll still have your shares. So you get to retain your shares, you get the $40 in premium, and then you did not get your shares called away, which is the reason why it's called a call. And then you can turn around and write another covered call if you want to, or let's say you bought your shares down here at the market price at $15, but it expires at, let's say, I don't know, $16. So your contract expired worthless, but you want to sell for profit, then you can sell for profit because your shares are no longer tied up. So the opposite could happen, where the strike, or basically the price of the underlying stock at expiration, expires above the strike price, in this case $17. So if it expires at $17.50 or $18, you will be forced to sell your shares, because that is the point of the covered call. Your shares are locked up until expiration, and then your shares get called away and you receive the premium plus basically the cost of what the covered call was. So $17 times 100, so $1,700 would get put into your account. Now, the combination of these two is what creates the wheel strategy. That's what we actually do on our positions. So if we go over here, you guys can see that we pretty much have all calls right now, but at one point in time, these were puts. So we did puts to get assigned these shares. And then, of course, now we're writing covered calls on them. So this is a great way to generate, it's not really truly passive income like dividends, because you are still kind of doing trades like with some of these stocks, like on a weekly or monthly basis, or if you do like the SPY or the triple Qs, you could even do it a few times a week, but we're not doing that yet. So it's a great way to create extra revenue that's essentially pretty much more or less passive. So kind of our goal here with doing this is we'd like to eventually make, I'd say, at least $1,000 to $2,000 a month just doing this. Obviously, we are going to need quite a bit more capital to do it, but we can kind of show you guys some of the premiums that we received just for doing basically covered calls within a 30-day period. So let's, that's odd. For some reason, it's not showing more of the history here. So, but yeah, I don't know why it's not showing the history. That's kind of weird. Maybe it's because we're in the middle of a covered call right now, but let me actually go over to the stock itself. Maybe the stock itself will actually show us what we need to know here. So we'll scroll down here for a minute. Okay, so here we go. This will show us a little bit more accurately what we're looking at, but as you guys can see here, March 26th, March 27th, we did basically a week out covered calls. We received some pretty serious premium, and then we did another one here for basically, I think, like 3 weeks. So pretty much between the 26th of March, 26th of April, just on those 3 puts and calls that we did, we received roughly about $780-ish in premium. And of course, we've received premium from all these other positions we have too. It's hard to say exactly what we're getting right now in terms of premiums. I think it's somewhere between, like, maybe on the conservative side, somewhere about $600 to $800 a month, maybe up to $1,000. But you can do this pretty much with any stock. Okay. So what's great about selling calls, selling puts, is you can do it with any growth stock. You can do it with a dividend stock. You can do it with a dividend growth stock. You can do it with an ETF like triple Q or SPY, or even something like SPLG. There is actually some of the yieldmax ETFs, believe it or not, also do covered calls, or they have options on them. Like, we'll take a look at that right now. I'm not necessarily interested in trading options on the yieldmax ETFs because they already pay pretty well as it is, but I do understand that this is an option, pun intended. So you can see that we'll probably have to go a little further out, as you guys can see here, but so if you do a month out, there is some options premiums here to collect on the, of course, 100 shares of Coney in this case. We'll take a look at some other examples. So Realty, this is a dividend growth stock, albeit a relatively high yielding one. It's a REIT. So a lot of people that invest in dividend paying stocks probably also do covered calls on this, and maybe even cash secured puts too. So you can see the options premium on this one is not that high, but then again, Realty is not really a very volatile stock. Of course, the more volatility a stock has, the more premium it's going to pay. But, still, you could potentially get $15 a month with this combined with the dividend income. And then if we take a look at something besides the Bitcoin miner stock, let's say the Robinhood stock with the platform that we're currently using, which is another position we're looking at taking in terms of running the wheel strategy. You guys can see it here. So we'll go 10 days out since we're already middle of the week right now. So, yeah, here it is right here. So if we already had 100 shares, we could sell right here at this 80% chance of profit. So this is basically a 27 delta. That's right between 20 and 30. get $27 in premium. And then, of course, if we bought now and the price went up to $18.50, we would collect $100 in profit. So basically $1 times 100 shares plus the $27 in premium, we'd get $127. And that's on a per contract basis. Now, if we had, like, let's say 10 shares, for example, you guys can see that would significantly boost our income to about $270 a week if this remained consistent, which is about, I want to say like $1,100 a month. Of course, if we keep going up the ladder here, let's be even more ridiculous about this and say we had 30 contracts, that'd be about $800 a week. You can see how this starts to add up. It starts to become pretty significant over time. The more shares that you accumulate and the more options contracts that you write. And again, this is specifically for selling and buying, or sorry, not buying, selling puts and calls. That's all this is for. We're not looking to buy. We're just looking to sell. That's it. So let's actually go over a few examples of when you might want to consider selling a call or a put. We can get more into more in-depth videos on this later. If you guys are interested, just let us know. We'll try to get something made for you. So actually, let's go with the Bitcoin miners because we're already taking a look at those right now. So we'll give you guys some good examples of this. All right, so we have support and resistance here. So when is the best time to sell a call? When is the best time to sell a put? It kind of depends. If you're looking to sell a put, do a cash secured put, but you do not want to get the shares assigned to you, obviously the lower the delta you want because you want to reduce the risk of assignment. If you're looking to sell a put, but you do want to be assigned the shares, then you want to make sure, according to technical analysis, that the price is not too much lower than support. Because if you put, like, let's say you put your sell put all the way down here at $10, but the bottom of support is $12.25, and you do actually want to get assigned the shares, you're probably not going to get assigned the shares. So ideally, the best time to sell a put is when you get closer, I'd say about the midpoint in between resistance and support, and are edging closer to support. That's the best time to sell puts. And the inverse is true for calls. So obviously, the idea here is to always sell a call for a price above whatever the market value is of your shares. And of course, above the strike price. Or basically, what I should be saying is you want like if your shares are at $14, let's say you bought CLSK at $14, you want your strike price on a call to be anything above $14. So that would basically guarantee that whether you have to sell your shares or not, you're going to collect the premium and you will still be in profit. So again, for selling calls, it'd basically be the inverse of this. So anywhere from the middle with the price moving up is the best time to sell calls. Of course, you want the market price to be above whatever your cost basis is. That is important. I would say the best time to sell calls is probably when you get close to about a resistance area. That would be the best time, because by that point in time, you'd be massively in profit. And then, of course, you could also, capitalize on that by getting the increased volatility in the premiums way up here. And again, it depends on whether you want to sell your shares to the options buyer or not. If you do not want to sell your shares to the options buyer, you want to pick a lower delta, like I'd say somewhere between a 10 to a 20 to basically essentially not guarantee, but pretty close to guarantee that your shares are not going to get called away from you. You still get to collect the premium. Or if you want to sell your shares because you'll be selling them at a profit plus collecting the premium based on your strike price, then again, you probably want to start doing that somewhere between the middle of the range to, I'd say, about the bottom of the support range. If you're not looking to get your shares called away, probably closer to the top of this range. And the inverse is true for the puts. So some of the different stocks that we're taking a look at writing these covered calls and cash secured puts on, we already have CLSK. We have a HUD-8, we have BTBT, we have Riot. We're also taking a look at SOUN, Soundhound. We've talked about this one countless times on this channel. We're taking a look at doing some cash secured puts on that. SoFi, Palantir, And then the other main one that we're looking at right now is, we might take a look at Snap at some point. That'd probably be a pretty good one too. But the other one is also Robinhood. At some point, we do actually want to do the triple Qs and the SPY, and I'm going to show you guys why now. So this is the SPY. Again, it would be very, very expensive to do a covered call or cash secured put on this. You would essentially need about 50K in capital. I suppose you could buy individual shares, but it would probably take a long time to get 100 shares. So the reason behind this is because the premiums are amazing, and as you guys can see, you can do them multiple times a week if you wish. Let's just say you wanted to go out to the end of next week because, this week's already halfway over with, just to give you guys an example of how much those premiums would be. If, let's say you wanted to be relatively safe and put it at like maybe an 80% chance of profits. So yeah, this is pretty safe, about a 21 delta. This would be basically about $200 or $2 times 100 shares pretty much every week. So one contract of this, $800 a week, or $800 a month, I mean. But again, it's very expensive to do. So anyways, if this is something you guys are interested in, you could take a look into it in your own time. Again, this is cash secured puts and covered calls. Selling puts, selling calls, or combined is known as the wheel strategy. Hope you all enjoyed this content. Please like, comment, and subscribe, and we'll see y'all later. Peace.